So let's look at another side of the equation. We'll stop picking on civil servants for just a minute. Let's talk about the public marketplace. So I asked our portfolio managers. I had a pretty good inkling that a lot of CEOs of major public corporations in Canada have pretty attractive pension benefits. You know, the recently retired CEO of Manulife is receiving a very healthy pension, which is worth about $11 million in total present value. Now, that's obviously an amount that nobody could seriously accumulate in an RSP in a working career. So we took a look at 23 CEOs of Canadian companies that disclosed what their pension liabilities were for their executives. Every one of these people have more than $10 million of pension benefits accrued so far. They're not even retired yet, so this number will get higher before they retire. The average for all 23 is $23 million. The total benefits are over $500 million, and it doesn't include the value of any long-term health benefits they're entitled to or any stock options that they will get. So, is anything being done to consider whether this seems to be a tax-favored long-term way of building wealth? Well, apparently not. So when we take a look at it, private companies are limited on their RSPs or IPPs. Pension income can be split, as we already noted. Private companies cannot accumulate this kind of tax-deferred savings no matter what they do. Public companies can also use stock options, and that's a very significant benefit because really it's deferred income that is, when you receive it, only taxed at 50% of, not 50% of the total income, only 50% of it is taxed at then the marginal tax rate. Companies, as David said, pay only 26% tax on passive income as well. So let's take a look at certain situations. Now here's a face you might recognize, okay, at least in the front. You know, he's older now than he was before, but he's still a pretty good-looking guy. So he's going to be selling the family business. We'll call him John, because when you're my age, you would always want to look like Sean Connery when you got older. Okay, so I thought I'd take a little liberty here and put my name on his. His daughter Jane would like to buy the business, but for years, this company has been coming to John, asking him to sell his business because they're interested in adding it to their stable of businesses that are like John's. John's business is not big. It's worth about $1.2 million. So Armco says to John, if you sell to us, we'll pay you the $1.2 million in cash, and your tax bill payable to the government, also known as Mordor, it's okay, Frodo does eventually win in the end, will ask you to pay $100,000 in tax, and you will net $1.1 million. So John thinks about this. He goes to his accountant. He talks to Jane, and his accountant says, okay, well, let's look at how that works if you do the same thing with Jane. You sell to her, your tax bill is going to be $470,000, and you will net $730,000 because you won't get the capital gains exemption selling to Jane, and you will be deemed to have received a dividend for the entire proceeds of the sale. And if we try to get Jane to buy those shares personally, she will need $1.9 million to get the same result as Armco can get with $1.2 million. So no matter how you try and do this, it's going to be infinitely more difficult for you to make a transaction within your family for that business. Now let's see what it looked like if we want to, quote, sell the family farm, so to speak. We have another couple, Jim and Rita, and their son, Luke. Now they have a farm co worth $2 million. This is very typical. Luke has been working in the farm for the last 4 or 5 years. They want to retire. They want Luke to continue to run the farm. Even if Luke, makes the best presentation he can to the bank, he's never going to get $2 million of financing to do this transaction. So the only way this works, their accountant said, look, why don't we do this? Why don't you guys, Jim and Rita, take back preferred shares in the company, and Luke will arrange for the farm company to pay you a dividend of 4%. There's no tax on this part of the transaction, and Luke will get the common shares, and maybe over time he can buy back those preferred shares, but in the long run, if you're going to pass the estate to Luke and his sister, really, as long as you have enough income from the preferred shares, maybe you never have them redeemed. And they're all good with this. They think this is great. They wanted to pass the family farm along. They're getting $80,000 a year from this. They're getting RSP income. They've got some CPP, so they're good. They're comfortable. And their tax on their $80,000 this year to Mordor is going to be $17,500. If tax reform passes as planned, next year their tax on exactly the same income will be $33,500. Now we're talking, this is on a transaction that has already been completed. And this would be an increase in tax. So when they say they're not going to make any taxation retroactive, if you listen to the rules and read them literally, that is simply not the case. One of the other issues that's a problem, this is a friend of mine sent me this chart, which is really interesting. It's about the average age of people who run businesses in Canada. And the age of the company owner, the number of owners that are now 65 and over in the last decade has increased by 65%. You know, basically we're trying to die with our boots on, if you want to think of it that way. And the number of younger owners that are under the age of 45 has shrunk by 25%. So here's an interesting question to think about. What price would a seller get if the tax cost of selling to a family member is 400% more than an arm's length buyer? You think the arm's length buyer doesn't know that that's true? And it's not going to make a difference to the price that they might offer? One of the other things Morneau talked about was what was called dead money. So he had the statement, tax changes will target dead money. He says, what I want to do is I want them to get that money out of those passive investments and invest it in productivity and new jobs, new infrastructure, new equipment, et cetera, et cetera. Now, 2 years before, there was this headline, Corporate Canada's cash hoard growing faster hits $630 billion. This is passive money in publicly traded Canadian companies. So let's just look at the tail of the tape, public versus private. $630 billion as of the end of 2014. Corporate tax rates, as we discussed, 50% for small business, 26% for the corporation. If you're going to pay the money out, which basically publicly companies typically do, and private companies typically do as well, you're looking at 23% additional tax corporately against on the public side against 22% on private side. The total tax difference, 72 versus 49. So the first question has to be, how can this be a level playing field? How is it possible that corporations with billions of assets and huge amounts of resources and the ability to borrow at prices that are like a fraction of what private companies would have to borrow, at the same time, with exactly the same investment, would be paying tax about 30% to 40% of the total bill less?